The narrow 2023 rally started broadening out 2 months ago in June. And with the latest surge in July, some interesting stats are popping up as to what cards the rest of the year holds. Let's head on over to the New York Stock Exchange, our very own Jared Blikre. He's holding the cards down there on the floor. Break it down for us, Jared.
Don't talk to me about concentration. I want to go straight to the Wi-Fi Interactive, where I have the sector action for today. A couple sectors in the red, looking a little defensive there. But let me just put a 2-month, and we're talking about the June-July period here. Retail, consumer discretionary, that is XOY, that's up 14%. Close on its heel is materials. Then we got industrials, energy, financials, communication services, which houses some mega caps. So you put all of that together, that's a pretty broad-based rally. And I have another way of showing that as well. If you take a look at this, the farther you are to the right here, and this is the Dow components, you got Caterpillar, that's up over 25%. The better the performance over June and July. The farther you are up, the better the performance January through May. Now we got Salesforce at the very top, they're up almost 70%, but it really hasn't done much since June, so that's why it's up there at the top by itself. Then we got Microsoft and Apple, not the best returns, but I think most people in Apple will take a 10% return, a little bit less than that for Microsoft. But just to show you, there are a lot more issues that have caught up and are trending this way to the right, which means better performance over the last 2 months than the prior ones. Then you take a look at the overall market, what the S&P 500 has been doing through July. I took a look historically, what happens when you're up by double digits, as we are now, about 18% in the S&P 500. And guess what? Really good results. Only one negative year, that would be 1987. So tailwinds definitely favoring the bulls here with respect to the S&P 500. Here's the NASDAQ. We got about 2/3 positive, but we do have a lot more red years, so not quite as bullish for the tech-heavy NASDAQ, but you put all this together and we're looking at some pretty strong tailwinds for the rest of the year. Anything can happen, and tailwinds like this, seasonality, only account for about 1/3 of the price action, so other factors, of course, can dominate. We can get a hot or a weak inflation print. But I think another thing that's happened recently that we need to pay attention to, which could upset these returns, is what is happening in the bond market. And here's a 10-year T-note yield. Last week on the news that the Japanese had potentially lost control of the yield curve there, our 10-year marched right back up to 4%. That's almost where it is right now. We start surging higher and the market starts repricing in a more hawkish Fed than is already priced in. We could definitely see equities take a stumble. Finally, here's the US dollar index. This goes back 2 months, and you can see after dropping through the support level, it was pretty quick to the downside, and we spent the last part of the month, the last 2 weeks or so, climbing back up to that resistance line. But in general, a higher dollar, bad for stocks, a lower dollar, good for stocks. Not exactly that black and white, but you get the picture there. So if the market were to roll back over like that, that would be very supportive for stocks. If we head back higher here, could be a little bit of a stumbling block. I would expect if that happens, if we get that stronger dollar, that would happen concurrent with higher yields and the market pricing in that higher for longer, even higher for longer Fed. But not getting too far away from ourselves right now. It's just looking pretty bullish from here. Even this big red candle, that nasty red candle that we got last week, well, that is being overcome as we speak, guys.
All right, well, we'll see what ends up happening next. That's always the fun of it. Thanks so much, Jared.